Welcome to this market update. We have investment and market observations that we'd like to share with you. The current financial crisis was encouraged by central bankers and their agencies around the world that kept interest rates artificially low for an extended period of time. These encouraged people and institutions to buy assets, all sorts of assets with high leverage. Now the Federal Reserve increased its Fed fund rate from 1% to 5.25%, but it seems that no real tightening of lending standards actually occurred at the moment. Actually, it seems that lending standards were eased at the same time and leverage increased in asset classes while the Federal Reserve lifted its interest rates. Now, in the current crisis, the Fed funds rate has been declining from 5.25% to 2%, and it seems that this has had a limited impact on the economy because lending standards have tightened at the same time, and this is done by the private sector. As many of you know, U.S. mortgages are no-recourse loans. This means that lenders have no recourse to the house owner beyond the value of the house. Now, which of course means that people that have problems with their mortgages are in a position where they have an incentive to default on those mortgages. Declining house values means that there is declining household wealth and that of capital institutions, which in terms, again, means weakened consumption in the U.S. economy. Now, weakening consumption in the U.S. economy has led to contraction of the trade account deficit, and that contraction has led to a further contraction on the current account deficit. Now, why is this important? The U.S. current account deficit has been the primary source for excess global liquidity, and that because of these contractions, we see that the U.S. dollar might have upside potential from its current level. Tightening lending conditions on the global scale have consequences that we believe not all investors are aware of. First of all, in the United States, we believe that commercial properties could be hurt and in inflation-adjusted terms. In the past, it seems that construction booms were local or they were focused on a specific market, whereas at the moment it seems that the construction boom has been on a global scale. Now, weakening global economy could lead to declining commodity prices as well if this weakening was significant. And this is not just in the United States, but it is in the countries where the demand for commodities is strongest, that is in the emerging economies. Which asset classes were to gain? In the case of declining commodity prices, this includes oil and gold. Significant slowdown in the economy would be negative for currencies in the countries that have benefited from the commodity boom. Now, this means Australia, New Zealand, and Canada, for example. We believe that in the upcoming months, U.S. equities and perhaps Japanese equities will outperform the emerging markets. If oil prices were to come down, this would be favorable for airline industry, and you might want to consider Singapore Airlines, Lufthansa, and Thai International in your investment portfolio. If oil prices are to come down and significant economic weakness would occur, we believe that this would hurt the entire material and metal sector, and you might want to see that U.S. steel is actually in an overbought state at the moment. What about the bond market then? In case of significant economic weakening on a global scale and lower commodity prices, it would seem rational to see bond yields come down. However, this is far from certain at the moment. Central bankers might cut down their interest rates, and in that case, of course, the bond market might not like that and it could sell off. This would mean that bond yields would go up, and in that case we again see upside potential for the dollar of the United States. Higher bond yields would naturally be supportive for the US dollar. we are concerned that investors are not paying sufficient attention to the problems that might arise from a significant decline in asset classes, and it seems that many investors wing proper asset allocation at the moment, and they're not doing it well and don't like to do that. We encourage investors to look for the portfolios and do proper asset allocation so that they can not only protect themselves from the changes that are taking place in the global economy right now, but that they can actually benefit from those changes as well. We encourage you to come to our website www.vagabondinvestors.com for further information on your asset allocation.